Well, we've had the Fed and we have had US inflation data. Last bit of it coming through today with the PPI report, which likewise gives us softer results, echoing the CPI report that came out yesterday ahead of the Fed policy announcement, suggesting that disinflation in the US is restarted in good order. Markets don't seem to make a whole lot of hay out of it, at least from the stock side, though bonds go up. But of course, now the question is, we are on the other side of this major event risk. We're on the other side of this major inflection point in market thinking. What's next? Where are we going now? What's going to power these markets from here? And that's the question that we're asking ourselves on Macro Money today. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is go through what is immediately on the menu in front of us next week. There's not a whole lot for the rest of this week. There is some. The University of Michigan Consumer Confidence Report can be market moving, especially when we look at the one-year inflation expectations gauge within that index that's coming at us tomorrow. But for the most part, big event risk is off the board. And so now, Bank of Japan policy announcement and those University of Michigan numbers aside, neither of which seem likely to present huge dislocations for markets. Now we ask ourselves if we are going to see anything between this and the end of the week, or if we should be focusing on next week. And that seems like the likely way that this lines up in my mind. And so what we're going to do is go through next week's announcements. They're assorted and interesting. But what we are going to do here is consider what exactly is on the menu. It's not like we have the kind of one-sided Fed focus or CPI focus next week. In fact, the U.S. data docket is relatively light. But we nevertheless have a good helping of macro risk to chew on. And we start with Australia. The RBA, the Reserve Bank of Australia, has a meeting that kicks off next week's event risk. The expectation is that we're not going to get any policy changes this time around. We can see the curve here as implied in 30-day ASX cash rate futures, holding at 435 for this month is clearly what's on the menu. We've adjusted a grand total of 4 basis points, according to what's priced in for June. And we'll notice that there's not a single meeting through the end of the year where there is a cut or a full 25 basis point adjustment that's on deck. Of course, there's been a bit of a hawkish shift we can see here in the curve from where we are currently to where we were at the beginning of May, when the RBA last met. And that's, of course, because we've had some CPI data, both monthly and quarterly, that has registered a bit hotter than expected. The first quarter numbers were hotter, and the RBA tends to use those quarterly numbers. The monthly ones are a little bit of a novel addition to the data mix for Australia. And the RBA has made the point to say it's the quarterly numbers that they're really benchmarking their target against. But those monthly numbers into the second quarter have likewise overshot expectations in April and in March. And so there's been a bit of a hawkish shift here, a hawkish rethink in the shape of these curves. We can see here was the March curve, and it still called for cuts. And if we see where we already were in May and where we now are by mid-June, those cuts have come off the board, and we've not really made significant strides from there. Here's the full 1-year outlook. Markets are anticipating a mere 10 basis point adjustment. That's that difference, by the way, between 435 and 425 in December. So we're looking at essentially nothing happening for Australian monetary policy, but that's not to say that we are not going to have price action that's linked to this policy announcement, because, of course, the markets are tilted in a direction. And so the question, of course, naturally is, well, how likely is it that you get a surprise the other way? If we look at Australian economic data, it has started to look soggier relative to forecast. We can see that here with the data from Citigroup on the Economic Surprise Index for Australia, courtesy of Yardeni Research here. And that could set the stage for some degree of dovish squawking in the policy statement, especially since, as we can see here, there is a downshift in the pace of economic growth a little bit. This is the PMI numbers spread from S&P Global, the benchmark for Australian economic activity. And we can see here that over the past 3 months or so, there's been a steady stair step lower. In May, we had the slowest cumulative pace of activity growth in manufacturing and the service sector since February. So it does look like the economy is decelerating a bit, having hit a very strident speed in March. But we nevertheless are looking at a situation where things look generally fairly good as relative to where they were, let's say, by the middle of last year, where we can see we are still trying to get above 50 on this index. That, of course, the dividing line between growth and contraction in the logic of PMIs. Above 50 is growth, under 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see this spent most of the first half of last year sub 50. So the economy, or economic activity growth, we should say, was shrinking. Not so here at this point. So on the one hand, yes, the data is getting a little soggier and it's getting a little slower, but it's not as if the economy is weakening in a scary sort of way. Disinflation is ongoing, though, as we can see here from both the overall and the core CPI readings from the Australian Bureau of Statistics. These are the official quarterly numbers year on year. So it is moving in the right direction. And of course, for Australia, the target is between 2 and 3%. So we're very much on a path in this direction. So what this seems to set up is, on the one hand, we've had some hotter CPI numbers, but disinflation continues. So they're hotter in relative terms. The trend is intact. And the economy is weakening a little, but not dramatically so. It makes sense why the markets are saying there's not going to be any policy changes. There doesn't seem to be a need for them that's screaming from the data at this point. The risk is that what the RBA does is anticipate a more pronounced slowdown and signal something akin to the oncoming scope for easing becoming greater. Of course, there's no knowing if they're going to do that. But when we balance the risks to what is probable to come out of this announcement, it's almost certainly not going to be hawkish in an environment where inflation is coming down and you're having the economy take a step lower on the growth side. If anything, it could be an extrapolation of the recent growth dynamics to something a little bit more dovish, moderately so, but you probably don't get anything that's too skewed in either direction. The balance of risks, though, is that if there is a skew, there is a greater market moving potential to a dovish skew, because, of course, the markets currently don't anticipate any easing. So there is something to price in there. So in the event that, of course, that occurs, the Australian dollar is likely to be a ground zero for the pain and is likely to come off these current levels and maybe start to revisit some of its lows near the 65 figure, the bottom of the recent range on 6A futures. The one eye-catching bit of U.S. economic data next week, the U.S. retail sales report. That's expected to come off the goose egg that it recorded in April with a rise of 0.3% month on month in May. That would be generally within the range that's been in play for the past year or so, right near the middle of it. This weirdness in January aside. And so you get the sense that there's maybe nothing to see here, except when you look at the way that U.S. economic data has behaved recently relative to forecasts, the Citigroup index that we like to watch has tellingly pushed through the 20-day moving average, which tends to be something that finds follow through because it lines up with the monthly rollover in the economic data cycle and the updating of forecasts that tends to track that cycle. So when you typically get through this, you might have scope to continue going higher, which could set the stage for this retail sales data to top expectations. What would that mean? Well, if we look right now, after the Fed and everything else that we've seen this week, CPI, PPI, we have the markets looking at about 4 leaning to 5 cuts between now and the end of next year. And as we can see, that's mainly made up of 1 cut that's on the menu for this year and 3 leaning on 4 cuts next year. So we can see here markets are baking in 16 out of the 25 basis points that they need to give us that 5th cut. So if we do the math there, that's 64% chance that we get that 5th cut. So the markets are tilting that way. Well, we look at the updated summary of economic projections from the Fed. That's exactly in line with the Fed's own thinking. Take a look. If we are currently at a median Fed funds rate of 5.33, which is the mid between 5.5 and 5.25, the Fed sets its policy rate in a range. So 5.33 minus 3.9, which is that rate that you see there in 2025, gives us 143 basis points in easing, which is a little bit more dovish than what the markets are currently anticipating, but not dramatically so. It's a little bit in the direction of 6 cuts rather than 5, but it is centered more to 5. And then for the market side, it is a little bit more in the direction of 5 than it is of 4. But again, it's tilting to 5. So we're looking at a situation here, essentially, where the markets are broadly in line with where the central bank is. There's maybe a little bit of scope for further dovish adjustment, but not a terrible amount. And so with that in front of us, we get the sense that maybe the object of speculation has been spent here. So if the retail sales data, let's say, does give us something north of expectations, the question would be, are the markets prepared to push things into a more hawkish direction? Well, given the Fed rhetoric and how the CPI numbers have been coming out, the answer is probably no. And so we get then this critical question, are we done speculating on Fed policy, and what does that mean? Because, of course, we can see here the rally that we've had in stocks, the rebound in these recent months, has perfectly lined up with a widening of next year's rate cut outlook. This sort of shifting of focus from this year to next, as the Fed signaled their kind of higher for longer stance that they, of course, endorsed with this week's policy update, coming down on 2024 cuts from 3 to 1. So, with that in mind, we have a situation here that seems to suggest that if there is no more speculating to do, and of course, we'll get some Fed speakers as well. We'll see how they factor into this logic. But it would seem to be that if you have a situation where the markets and the Fed are in alignment, then perhaps what you've done is you've run out of reasons to consider that there is further dovish speculation to power stock markets that has room to occur. Now, that, of course, is something that is completely unconfirmed, and we're going to have to watch and see. But the risk here seems less so, and again, we're doing this as a kind of consideration of relative surprise risk rather than relative policy risk or data risk. If the situation has gotten to a place where the markets and the Fed are broadly in alignment, then perhaps what you're looking at here is a situation where people are just compelled to say, you know what, it's been a good run of outcomes. This has been a potent catalyst for moving this forward. And where we are now is a place where perhaps we are at this stage out of reasons to keep the narrative going. And of course, if that's the case, then you could see an adjustment in risk taking and a pullback in stocks just around the idea that people are divesting of speculative exposure that no longer has a narrative to power it. Or not, of course. And a big level of controversy here is, needless to say, whether the Fed took account of the weak May numbers when it set its expectations. This is the most recently updated SEP here. Of course, we can see the Fed increased its expectations for inflation here, both for this year and next. If they are truly factoring in this hawkish adjustment in policy into their assessment of that data and still are this hawkish, that would be a different thing than if they're not. And if there's still a dovish adjustment to be made. If that's what we get in the language from policy officials going forward saying, look, we didn't take May into account, then perhaps there is still something to speculate on, and there is a reason for stocks to keep going higher because there is more for this to go. But if there's not, then we're relatively anchored. And so from that perspective, you could see just the absence of speculation, the act of the speculation becoming reality that deflates scope for stocks to continue to benefit from this narrative. Doesn't mean they can't benefit from another one and there can't be handoff. But it is possible that the Fed is going to cut story is running out of juice because the markets and the Fed have come to some sort of an agreement. The Bank of England also announcing a policy next week. No changes expected this go around, only 5 basis points baked in for June, but still cuts on the menu. We can see that at least one of them is already baked in for November and is almost all the way there for September. And by the time we get to December, the probability of a second cut is meaningful as well. It's not quite down to 4.75. But it is there. And so we can see the cumulative tilt is for 42 basis points in cuts this year. That's almost 50. So that second cut is almost there. The progress toward disinflation for the UK continuing. UK CPI data due next week, expected to show that headline inflation has dropped to 1.9%. That, of course, would essentially meet the Bank of England's target. The question for them will be, do they expect it to hold or do they expect reacceleration? Looking at the components here, energy has been the big downdraft, and there's these pockets in recreation and hospitality that really are, at this point, the main catalysts. This is where you could get a bit of risk, because if you look at the way that UK economic data has performed relative to forecasts, it's meaningfully improved. And so you might have a bit of room actually to say, well, these things are stickier. And if they're stickier, then the Bank of England may not be in a position to cut as aggressively as this implies. We could come down to one cut yet. So the risk might be that the British pound, of course, responds positively, but also that local stocks in the UK are hurt. And EWU, the ETF tracking UK stocks, has in fact been moving significantly lower recently. And finally, at the end of the week, we are going to get the June update of flash PMIs. This is going to be a gut check on global growth. If we look at what's expected, it's a bit of a cooling in the US after the very sharp jump in May. For the UK, you're looking at a bit of a pickup. Tellingly, as we just saw, the data has been improving relative to forecasts. For the European Union and the Eurozone, you're looking for that to get a little bit soggier. That makes sense, of course. They've already started their rate cut cycle, but their stocks have fallen too. And that's not something that screams confidence in the idea that the first round of cuts in rates in 5 years will pour gasoline onto a rebounding economy. Not quite at all, as a matter of fact. So that's expected to cool and maybe show that momentum in this post-recession bounce we've seen this year is fading. Overall, we can see global economic data has been deteriorating relative to forecasts since April or so. And the concern now, of course, if it continues to do so, then all of these central banks will get the excuse to do the cuts they want because the global business cycle is turning, but stocks don't actually like it when the cuts begin, as we've just seen from the ECB, because that doesn't happen for good reasons. They like speculating on the cuts, not actually seeing them. And that's the week ahead. I will be away from the desk next week, so Macro Money will be on replay next week. We'll have some choice relevant episodes for you. The following week, it will be back to its regularly scheduled programming Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what it might mean. I will be on quite a bit tomorrow for a Futures Power Hour and for Last Call with Chris. And the following week, I'll be away, but the week after that, back on The Price of Truth with Victor Jones, back to First Call with Victor and Tom as well. In the meantime, have a great trading week. We'll see you tomorrow for Futures Power Hour and Last Call. Take care.